Hey folks, welcome back to Modern Day Money. I'm Carlo, and today we're going to talk about marginal taxes. The first thing you need to know about marginal taxes is that you don't have to pay them if you hit the like button for the YouTube algorithm. Okay, but seriously now. Taxes can be a daunting financial task to deal with every year, but they don't need to be. For the vast majority of people, especially young adults, there's really not much to it. But instead of telling you how to do your taxes, let's go over how taxes are calculated to begin with. In the US, as with most of the world, our taxes are set up in a way called marginal taxes. Have you ever heard the phrase, "Don't accept that raise because it'll put you in the next tax bracket and then you'll end up making less money"? Well, I hope you haven't, but depending on your work environment and upbringing, perhaps you have. Right off the bat, this statement is completely incorrect. But you can see why there may be some confusion. The way the majority of income tax around the world is set up is by tax brackets. Now this video specifically references the US tax system, so there may be some differences elsewhere in the world, but most countries follow a similar system. The US tax bracket is categorized by a couple different things: the amount of income you're declaring and the type of filer that you are. Now this is all specifically for regular income tax, capital gains and business tax and real estate, etc. Those are all offshoots and they have their own sort of nuances that will be covered in a different video. The filer type is single, married filed jointly, married filed separately, and head of household. The tax rates are consistent for everyone, meaning the first tax rate is 10%, then 12, 22, 24, 32, 35, and 37. The amount that gets taxed within each of these brackets, however, is different from different filers. You will notice that it is essentially all the same on a per person basis, however. The first tax bracket is 10%, and it's your first $0 to $9,950. The next bracket is 12%, and that's from $9,951 to $40,525. The next bracket after that encompasses most people, and that's at 22% between $40,526 and $86,375. And lastly, we have the top tax bracket of 37% for all income over $523,601. Now, if you didn't know how marginal taxes worked, you could be forgiven for reading the table incorrectly. Based on the phrase from the beginning of the video, "Don't accept a raise because it'll put you in the next tax bracket and you'll make even less money," let's come up with a hypothetical scenario. Let's say you're single and making $160,000 a year and you're up for your annual review. Let's say there's no big promotion coming or anything like that, but you've been working hard, exceeding your expectations, and all you're expecting to receive is the higher end of the customary 2 to 4% annual raise. At 4%, that's a $6,400 raise. Your income would increase to $166,400 and your tax bracket went from 24% to 32%. If the previous statement was correct, you would go from being taxed $38,400 to being taxed $53,248. Your new net income is $113,152, whereas before it was $121,600. That's a loss of over $10,000. Let's face it, that would be outrageous. But thankfully, that's not how taxes work at all. How they actually work is far more sane. Marginal taxes work by using margin. The tax rate of each bracket only applies to the amount of money within that bracket. So in the same example from 1 minute ago, if you were making $160,000 per year, you weren't being taxed at a flat 24%. It helps to think of each bracket as a separate glass being filled by water, the water being your paychecks. Your first paychecks of the year start off going into the first glass, the 10% glass. Once you've earned $9,950, the next paycheck go into the next glass, which is 12%, then the 22%, and then finally the 24%. In the first glass, you've poured $9,950 of water. In the second glass, you've poured $30,574 of water. We got to this number by subtracting $9,951 from $40,525. In the third glass, we fill it with 45,849. Again, this is 86,375 minus 4526. And finally, in the fourth glass, we pour $73,624. Now, from the first glass, we remove 10% because that's the first bracket's tax rate. From the second glass, we remove 12%. From the third, we remove 22%. And from the fourth, we remove 24%. This would give us $995 from the first glass, $36.68 from the second glass, $10,066 from glass number 3, and finally $17,669 from the fourth one. Add all these numbers up and we get $32,420.76. If we divide this by 160,000, which was our gross salary, we get 20.2%, which was our effective tax rate. I know that was a lot of math, but hope you're still with me. Now let's do the math on the raise. Our total income has increased to $166,400. The first three numbers, or the first three glasses, are going to be the same. But now we're going to have a fifth glass because we're entering the 32% tax bracket. The 24% tax bracket is now going to be maxed out at $78,549. The fifth tax bracket is only going to be $1,474. So 24% of $78,549 is $18,851, and 32% of $1,474 is $471. If we add this to the previous numbers, because they are still the same, we get $995 plus $36.68 plus $10,086 plus $18,851 plus $471 equals $34,074.10. I hope all that makes sense. That is all the math we're going to do, almost. Again, if we divide that number by our gross income, we're going to get 34,074 divided by 166,400, and that gives us a 20.4% effective tax rate. So notice how despite going up into the next tax bracket, our taxes only increased by 0.2%. And that is how marginal tax rates work. Only the amount of income that falls into the tax bracket is taxed at that bracket's rate. Now, this of course was a simplified example because we didn't take into account any sort of deductions or pre-tax investments like 401ks, but it doesn't matter because the math is still going to be the same. That kind of detail, deductions, stuff like that, that'll be explored in a whole different video. Now, you may be wondering yourself, why the hell didn't anyone tell me this when I started working? Great question. Chances are your boss may not tell you you're making a mistake taking less money because it's less money out of their pocket if it's a small company. Morally and ethically wrong in my opinion, but not all bosses are necessarily great people. Chances are though, at a large corporation, they'll explain this to you. If you contact HR or payroll or anything like that, they'll tell you everything you need to know. So the next time you are offered a raise, take it. And if your friend or coworker or relative or whoever tells you not to take a raise because it'll increase your taxes, you can sit them down, we can watch this video together again, and then they can learn how to make more money as well, and they can learn how marginal taxes work. As always, thank you so much for watching. If you liked the video, be sure to hit that like and subscribe button for plenty more videos to come. If you have any questions or comments, please leave them down below and I'll get to them as best I can. And until next time, see ya.